When people make a decision to buy a Medicare Supplemental Plan G, sometimes the focus is on what the initial premium is going to be. In other words, they compare companies and they look at premiums and they think, I'll just go with the cheapest company that's available to me. Folks, that is not what you should be looking at. We also have to consider what are the future premiums. In other words, we know prices are going to go up, and some companies tend to take more drastic price increases and more frequent price increases, and those are the companies that we want to avoid. So in this video, I'm going to show you how initial premiums are going to be established by companies and also how we'll see premiums increase over time as well. Now, depending upon what state you live in, you have one of three different possibilities for the types of policies that are being issued, and it's the insurance commissioner that makes this decision. Many states are what we call attained age states. Some are going to be issue age states, and there are a few that are going to be community rated states. Now, the difference in these three different types of policies when it comes to the initial premium would be this. In an attained age state policies, when they're written, that policy is going to be written initially based upon the age of the insured, their gender, and their tobacco status. So we look at age, gender, male or female, and non-tobacco or tobacco status. And that's going to give us the initial premium that's going to be charged. In an issue age state, those same factors are going to be considered. When I first come in and get a supplemental plan, it'll be based upon these factors. Now, the difference here is a community rated state. And what that means is that everyone who's buying a policy at the same time, regardless of their age, regardless of their gender or tobacco status, are going to be given the same rate. All right, so initial rates are based upon those factors. Now, what the difference is when it comes to future premiums. How are these premiums going to be adjusted into the future? And so the way that works is this. In an attained age policy, we're going to see a slight increase every year because of age, plus occasionally we can also see a group increase. When it comes to issue age, those policies cannot be raised every year because of birthday, but we can still see group increases. And the same thing is true community rated. They're going to go up as well, but again, that's going to be a group increase. So it's only the attained age policies that will see a slight increase every year because of age. Now, when it comes to the initial premium, the attained age is always going to be the lowest. So just give you an example. Let's say we have an attained age policy at $110 a month for a Plan G. And issue ages are going to probably come in the range of about $150 initial premium, and a community could come in somewhere around $200 a month. So those are always going to be higher. And so that's the initial premiums. Attained age is always lowest. Now, when it comes to group increases, they are going to occur with all of these, but some companies, again, are going to be more drastic and more frequent. So here's the way a group increase occurs. So what is happening in the group is we have the policy holders pay in their premium. And they're paying a premium to an insurance company because they transfer the liability of their gaps in Medicare to that insurance company. And so as that insurance company assumes those gaps, obviously that company is paying money out. And this would be in claims. So money goes in the group through premiums, and money goes out through claims. So money goes in, money goes out. And so group increases can only occur when more money is going out of the group than is coming in. So claims exceed premiums. And when this happens, regardless of what kind of policy you have, then that insurance company is going to go to the state insurance commissioner and they're going to say something like this: we're losing 5% in this group. And so they're going to petition the insurance commissioner for a 5% increase. So this 5% increase has to be approved by the insurance commissioner of the state. And the insurance commissioner's job basically is to protect the consumer, to be sure that this increase is justifiable. And there's certainly a paperwork process involved, and this process they have to follow. But if that insurance commissioner sees they are indeed losing 5%, they will allow that insurance company to go up 5%, and everybody in the group goes up. So these two here can only take group increases. These here can take an increase every year at birthday. It usually goes up maybe $40 or $50 for the whole year divided by 12. So they'll take slight increases every year plus an occasional group increase. These are group increases only. Now, I have a lot of people ask me, well, which is best? There is no best. The insurance company is going to be dictated by the insurance commissioner to decide what kind of a policy they're going to be issuing. And so there really is no best. What really matters in all of this is the size of the group that you're going into. So what we like to do is we like to go with companies that are nationwide nationwide companies that have large group, because what's happening is it's the health of the group that really determines how often that company is losing money. So if I've got a lot of cancer in the group, I've got a lot of knees and hip replacements and those kind of things going on, then we have the tendency to have more claims. And so because we don't know the health of the group, what we then look at is the size of the group. So if I have a large group, a nationwide company, lots of policyholders, then the health risk is spread out to more policyholders, and then I'm going to see less of these, less frequent and less drastic price increases. But if I have a smaller group, what's going to happen? If I have an unhealthy small group, we're going to see more price increases. Just a quick illustration, if I was in the ocean and I was in a canoe, I guarantee you that every wave that comes, I'm going to feel those waves hitting my canoe, and it's going to be very impactful. But if I'm in that same ocean, I'm on a cruise ship, I probably can't even tell I'm even in the ocean. That's a large group, and the same thing happens when it comes to health insurance. The more people that's in the group, the more risk is going to be spread out, and we're going to see less price increases, and so the result to you is going to be stability of rates. And so all three of those are going to go up in prices. So what matters is not these three factors here, but what matters is the size of the group. And so we look at the stability of companies by looking at how large of a group they have, how many policies holders are in there, so that health risk is spread out to more people. And that is what's the most important thing when you buy a Medicare supplemental plan. Not the initial premium, but how large is that group and how stable has that company proven to be. I hope this video was helpful for you. In fact, really, that's the whole goal of this channel, to make sure that we're giving you the best Medicare education possible so that you will avoid making huge Medicare mistakes. So if you found it to be helpful, please feel free to like, subscribe, hit the bell, and every time we do a new video, you'll be notified. As always, we wish you the best in your Medicare journey. See you on the next video.